A mechanical system can really help to minimize your losses because you develop and make a step-by-step process and knowing if the market does this, then you're going to do that. If the market doesn't do this, then you don't do that. The process alone helps you make consistently 5 figures a month in trading payout. And in this video, I'm going to break down the exact step-by-step process you need to build a mechanical system. And this video might be longer than some of my other videos. This is only because I'm giving you the real source that you need to understand by building a mechanical system. You're no longer going to be guessing if the market wants to go higher or if the market wants to go lower. You're going to be able to sit in front of the charts and know exactly what to look for and exactly when this is going to unfold. So with that being said, let's get into this video and break down exactly how to build a mechanical system. I will be giving you guys a complete mechanical approach to these markets and a step-by-step process that I do use myself and I have found profitability with. And I do have my glasses on, so that means you guys are in for a treat in this video. I don't know how long this video is going to be, but what I do know is this video is going to be filled with a lot of information that you can actually take on board and apply it to these markets as candles print. So it doesn't matter what kind of trader you are or what level you're at right now. At the end of this video, the approach is going to be you're going to become 1% better and you're most likely going to have a light bulb moment. So the first things first, what we need to understand is why do most traders fail? Like, this is the number one thing. Everyone says that 95% of traders that come into these markets, all of them fail. To me, that statistic is wrong. I actually think it's around 70% of traders actually fail when it comes to these markets. And the other 30% have actually seen profitability within these markets. But the thing is, they've not seen any consistency. And this is what I'm trying to teach you with this approach by building a step-by-step process and having something which is repeatable over time. And why is it that traders that have made money from these markets, but they've also lost money? Well, the number one thing is they had no process. They were just simply gambling and hoping something would stick. So if they're gambling and just randomly taking trades, 9 times out of 10, a few of those trades are actually going to be winning trades. But over time, if you continue repeating this process, those trades are basically going to ruin your trading account. So all of them, what they're doing is basically they're trading on feelings, not any rules. And when it comes to trading, if you have a mechanical approach, you're not trading how you feel for that day. You're following a step-by-step process. And if something falls within that process, then you take your trade. And then the next thing is they have no consistency. The thing with most traders is every single one of you watching this video has the potential to make money over time on a consistent basis. But the thing is, you know exactly what you're doing wrong, but you're choosing not to admit that you're doing things wrong. And that's where the no consistency falls into place. You're taking random trades based off purely because you're bored. So when traders are failing over time, these two are the most common processes. Either they're gambling and hoping something's going to stick so they have no rules, or they have no consistency in their trade. Every single trade that they do take is different to the one that they took previously. And let me tell you this one thing, and if you wanted to go through my Twitter page where I broke down all of my trades, all of my winning trades look the same or similar to the previous ones. And do you know why? This is because I follow a simple, repeatable process every single time I sit in front of the chart. And then the third thing is why most traders are failing within these markets is because they focus on the profits. They don't actually focus on executing on a plan or executing on a system that they do have within the market. So if you're focusing only on profits and the P&L, obviously this is going to hurt your psychology because you're just watching numbers go up and down. And if you're not ready to take a risk on a certain position and you're seeing you down over 50% on a random trade, then obviously this is going to hurt your mental capacity. And this is where risk management and having a repeatable system comes into play. Like, it's very hard for you not to become profitable if you have a step-by-step process like we are going to get into. But firstly, we need to break down why most traders fail. And I know some of you might be resonating with this, and this might be a light bulb moment to sit back and realize this is why I've been doing wrong. And then the next thing is simply traders can't sit out the markets. They want to be in every single position. They want to catch every single move, and you're never going to catch every single move. You're going to miss moves. Trades are going to form without you. And you know, the one thing you can do is realize, okay, these moves are going to happen again, and I'm going to be able to trade them again if I'm in front of the chart. Like, the market doesn't care how you feel or if you missed your setup or anything like that. But the only thing you can do is wait for that setup to form again. If you're chasing that trade, this is where you're going to be forcing your trades out of pure boredom or FOMO. And if you seriously have fear of missing out right now, you don't have a system which is repeating within the market. But Don't worry, we are going to get into that. And then the final thing is they don't learn. Like traders, most likely every single mistake they make, they don't look back to why they made that mistake. They're always looking to blame other people. And self-awareness is so important in trading. Like I can't put enough emphasis on this, because if you know what you're doing wrong and what's going wrong, you're actually ahead of the 95% of people within these markets. Because as people grow and become adults, they can't take accountability for their own actions. Like if they mess up or do something wrong, most likely they're looking to point fingers at someone else or point fingers at something else that made them do that, not them taking a step back and going, okay, this was me that made that mistake. How can I better this mistake so it doesn't happen again? And the same thing goes for trading. Traders will take a loss and they'll take a losing trade. They won't journal that losing trade. They won't even review what went wrong. They'll just continue repeating the same mistake until they get sick and tired of that mistake. And there's two routes that a trader goes at that point. Either you quit and you never look at these markets again and you're like, these markets are a scam. And these markets aren't a scam. You simply couldn't take a step back and realize it was you doing things wrong. Like these markets are never going to turn around and go like, okay, I'm not giving you this money. If you make that money is yours. And you need to have something in place which will help you make that money, not just aimlessly gambling and hoping something will stick. So we just gone over why most traders fail, and the statistic of 95% of traders failing, in my opinion, is around 70% of traders fail. Most traders do actually make it to a payout and actually making money from a live brokerage account. But the thing is, over time, on a consistent basis, they actually fail on the long run. And that's mainly due to not having a repeatable system. And I'm going to teach you a complete mechanical system right now. So if we look over here to my left, this is a mechanical system. So what is a mechanical system? This is basically where you follow a set of rules without second guessing yourself. So if the market tells you to sell and your emotions are like, I need to buy this market, I feel like this market's going to go higher, you're not trading based off your feelings. You're trading based off that system. So if the market tells you to sell and your system tells you to sell, you are getting in that sell regardless if the market goes higher. This is because over time you're trusting a profitable system. Are your emotions profitable over time? No, they're not. So if you're going to trust your emotions and trust how you feel in that moment, then you might as well just buy a coin and flip it every time you want to trade. So with that being said, you will be building a system, which is where you're going to follow a set of rules without second guessing yourself. And the elements of this is always going to be time. So this is why I like to teach and I like to approach. Time is the most important variable to these markets, because I can talk about this for hours on end. But the thing is, a lot of people are teaching regarding candlesticks. They're talking about candle 1, candle 2. They're talking about SMTs. They're talking about fair value gaps. All of that is amazing and all, but it's very irrelevant if you don't have time considered into any of this, because it's very ambiguous to say that this is where a candle is going to take out the high, you're going to look for a short on the third or fourth candle. And it's very ambiguous to say this is SMT made within a gap, but you need to look for a long or a short, because in my opinion, this could really hurt a lot of traders over a long run, because you don't have any consideration of time within the market. So time, if you are looking for ranges to form, because this is all what the markets work on, ranges, time, liquidity, and imbalances. That's it. That's literally what these markets are looking to do every single day. And once you start to approach the market from the lens that I'm going to go over, it'll really help you to have a light bulb moment. And don't worry, we are going to get into the charts and everything, but I wanted to show you a mechanical approach to these markets like this. This is where I'm trading a dealing range approach. I find a swing high and I find a swing low. And don't worry, when we go into the chart, I know a lot of you have questions about dealing ranges. You're like, okay, you selected this range, but what if I zoom out and there's more ranges? And don't worry, we are going to get into that, but let's focus on this example right here. So why did I even take this long in the first place? You can see we have a dealing range low and we have a dealing range high. 930 becomes important if we're trading indices. Regardless of whatever's happening, always wait for 930. Either 930 is going to run for liquidity or play continuation. That's all 930 does. And if it runs for liquidity, you know that this is a manipulation phase that the market's within. So you can see right here at 930, we trade lower and take out the sell side liquidity. Once we take out the sell side liquidity at 930, what happens? We immediately start to reverse. So in my head, this is like, okay, the market drops lower at 930. What does this mean? This means that this is a manipulation phase that the market's within. So once I see this, I'm looking at this fair value gap right here. Why is this fair value gap holding importance to me? Because I'm looking for a confirmation for the market to tell me it wants to go to the upside. So if this market was bearish, you see this bearish fair value gap that I'm circling, we should have traded into it and traded to the downside. That gap fails, and then we make this fair value gap right here. This is the one I'm looking to buy and targeting the buy side liquidity and the opposing end of the dealing range. And you might be asking, why are you not looking to buy from this fair value gap? If price drops into this fair value gap, this is where I would have added more into my position, but I wanted to enter within the market, put my stop below here, and this is where I want to target the high, because sometimes we're going to leave breakaway gaps. And what is a breakaway gap? Because no one on YouTube is really teaching them. A breakaway gap by definition is a delayed delivery. So when the market is trending in one direction, or it wants to go to a certain level. So for example, it wanted to go into the buy side liquidity. Oftentimes the market is going to rush into those areas and create areas of imbalance. So this was an area of imbalance. Once we push to the upside, this becomes a breakaway gap. So this becomes a delayed delivery. And what does that mean? For now, the market can leave this level open, but later on in time, it can return back to here, rebalance it, and then do whatever it wants to do. And then we trade into this gap. So what is the importance of this gap that I'm circling? So this gap becomes important because this is where the market started to consolidate. So this is actually what a real balanced price range looks like. A balanced price range isn't just random fair value gaps overlapping each other. This is the thing. Everyone's teaching about BPRs and stuff like that, but they truly don't understand the market to a degree that they should have studied, because everyone's learning from each other. No one's doing their own study and realizing what goes on within these markets. So we just spoke about breakaway gaps and what they are by definition. And again, if you can't define something, you don't truly understand it. That's why I'm teaching you the definitions and actually showing you how they form within the market. And the thing is, you can see right here, this is where the market starts to consolidate. And a consolidation often means this is where the market is creating a balanced range. Why does this become balanced? This is because price is offering both buy side and sell side within a specific level. And that level is this fair value gap. So we offer buy side, sell side, buy side, sell side, buy side, sell side. This range becomes balanced. And how does price break out of a balanced price range? This is very important. Price will break out of a balanced price range with one thing, speed. And that speed comes with a fair value gap. This is why oftentimes you'll find a breakaway gap forms here. This is where the price doesn't need to return back to you. And why doesn't price need to return back to here? This is a delayed delivery. So once it took out this buy side liquidity pool, then it can drop back into here. But it was on a mission. It wanted to reach an objective for a specific time. It wanted to pair orders at a very specific time. And this time was 10:30. So into that 4-hour candle, we reached the buy side liquidity objective, and then we can reject the way back into the liquidity pool. So this is going over a mechanical system. I know there's a lot more that goes into it, and we are going to get into it. So this video might be a bit longer than usual, but the thing is, this is what I wish I had when I started in my trading. I'm giving you the complete approach to building a mechanical system, and most importantly, something that's helped me make money from these markets. Because if you want to make money long term, you have to do the boring stuff. And if you made it this far into the video, you are most likely going to be ahead of 95% of people that come into these markets anyway, because you're listening to this, you want to learn how to trade these markets. So we went over why most traders fail and the 5 key components to that, and how you can actually fix that to become better as a trader and mentally within the market. And then we went over how a mechanical approach is actually made trading within these markets. I broke down one of my trades that I took for a long to the upside, and I also showed you a bit of P&L that I did make from taking that trade. So you can see this was across 3 accounts, and I was just copy trading them. So this is the power of copy trading, but this is also the power of understanding time and having a mechanical system. But again, that alone isn't enough. And now we are going to go over how random trades that you do take lead to random results, and how you can better this by creating something which is mechanical and step by step within the market. So if we look to the left right here, you can see this is a logical approach. This tells you where the what, when, and how happens within the market. So this also leads to having calculated expected results from the market. So over here, you can see we have a dealing range high and we have a dealing range low. So ranges to me are very important because this gives you clarity in knowing what the market wants to do. So even when the market takes out the low of the range right here, even if we don't take out the complete high of the range, there's always going to be a scalping opportunity to a midpoint of this dealing range. This is because either you're not going to have a full reversal, but you are going to have an area of a retracement that the market wants to go into. So for example, if we take out the sell side, the market trades back into around 50% of this level or whatever. So we have a retracement, and you can look for the market to trade to the downside if you know that the market wants to continue trading in that direction. So this is where the importance of understanding a range to me is very crucial. But over here, you can see we have a high and we have a low. So you're always waiting for one side of this range to be taken. And what time are you looking at? If you're trading the New York session, then you're waiting for 9:30. And if you trade the London session, you're waiting for 3 a.m. And these are my blueprint time windows. There is also an Asia session time window as well. That video is on my channel, but I will leave a link to that in the description down below. And I do believe the Asia session video is very helpful for those of you that do trade the overnight session. So over here, if we look at 9:30, price trades lower, takes out the sell side liquidity, takes out a range low. And then what happens? So I drew this red box for you guys to have a look at. You can see this red box, we close above it. But why is this red box important? As we went over in the first trades example, if the market's going to trade lower, it's going to trade lower from this area. And why is it going to do that? And that's because price is going to retrace back to area of 50% and play the continuation. However, this doesn't happen. So this shows you that the market wants to have a complete reversal, and trading to the opposing end of the range is pretty high probability. So from here, once we close above this fair value gap, this becomes an inversion level. And again, this is where you can buy from. This is where the breakaway gap happens. So as we spoke about before at the start of the video, how do breakaway gaps happen? What is a breakaway gap? A breakaway gap is a delayed delivery. So the market can come back into here later on in time. You can see we consolidate. So what happens? Once we consolidate, we create a balanced range. Once we create a balanced price range, you can see how does the market need to break out? It needs to break out with speed, and that's what we do. And we trade into the buy side liquidity, and we leave this gap open. And I'm going to give you a bit of source right now. So if we create a balanced price range above the marketplace and there's a fair value gap below us, if you made it this far into the video, this gap, you can anticipate it to be left open because the market's created a balanced price range. And from this balanced price range, if we're bullish, the market should rally on to the upside. So that was a bit of source for you guys that made it this far into the video. And if you have made it this far into the video, I wanted to let you know as well about my one-on-one mentorship if you are interested in joining that. If you want to learn more about these markets and especially learn the why aspect of why things are happening, why price is reversing, retracing, or continuing at very specific levels, that's basically what I go into inside of my mentorship. So not everyone's going to need the mentorship, but if you do want to learn more about the markets and get more comfortable with understanding what's going on, that's definitely the place to find me. And if you are interested, there is a link to that in the description down below. It is an application process, but you can see the results that have come by from my other previous students and see how well they are doing in their trading. But with that being said, let's look at trading aimlessly and taking random trades. So you can see right here, we also have a dealing range low, and we also have a dealing range high. So this is valid to take a long, right? This is where price pumped to the upside, closed above this. Mechanically, a lot of people are like, okay, this is where I'm going to buy from. You hit your stop loss. But why did this hit stop loss and what went wrong? Well, the main thing is you're trading at a random time. So this is around 6:15 a.m. on New York. So timing is off. New 4-hour candles also opened, and you're looking to buy as the 4-hour candle just pushed to the upside. So you need to think about these markets very logically. Like there's certain things that you need to think about and know what's going on, because if you don't think about them, then the markets can easily chew you up and spit you out right away. So stop taking trades aimlessly and have a real plan going into the markets. Wait for a specific time. Wait for that time to come by and wait for things to happen in place for you to take that trade. So I like to go with this thought process. If the market does this, so if the market does X, then I will do Y. If the market doesn't do this, then I won't do Y. So this is basically a thought process that I like to go with, and it just helps with my trading plan. So if the market's going to do this, so say, for example, it reaches a higher time frame objective like there, I'm going to look to take that trade. If the market doesn't do that, then obviously I'm not going to take that trade. And this is basically helping you with your understanding of, okay, I need to sit out. I don't need to do anything. And that's, again, going back to why most traders fail. They simply can't accept the fact that there's nothing for them to do within the market, and they just have to sit out. And this is where we went over taking random trades, leading to random results, understanding when, what, and how, because this is very important when it comes to trading. If you can understand and explain to yourself, or before you take a trade, when this is going to happen, what's going to happen, and how it will happen, this is basically where you have a trading setup which is valid for you to take. Now, going over that, we are going to go over what makes the higher time frame important and what is the importance of the higher time frame. So knowing what the higher time frame does, it makes a mechanical system very high probability. Like, I'm putting a lot of emphasis on this because I know, because this is how I trade. I look at what the higher time frame tells me, dropping onto the lower time frame makes it very simple. And these are the magic numbers and the Fibonacci levels that I look for. Everyone's looking for the holy grail. Everyone's looking for something that's magically going to make them profitable. I'll tell you this one thing. If you really want confirmation and you really want conviction of where the market wants to go, I'm going to teach you about my grading price swings. And I did do this video on T-Trade's channel. I think it was one of my market maker model videos. And that's where I went into detail about understanding a grading price swing, when the market's going to reverse, how the best market maker models form as well. And that video was obviously ahead of its time. It still is. So if you look around, most of the videos out there really don't teach about that kind of stuff. This is because I've done my studying. I've been through these markets, and I've actually studied a lot more than most people will ever try. And I've also forgot more than most people will ever learn about these markets. So if we're going into this, reading candlestick order flow, so this is where I've just simplified everything in a form that you guys can understand and apply it when candles are printing live. So I've also color coded this as well. So green is the 0.75, purple is the 0.5, and then pink is the 0.25. And we're going to get into what makes them important in a second. But you can see order flow and understanding candlestick order flow. This is how I like to look at it. There is a video on my channel. I will leave that in the description down below. But this is basically how I'm anticipating the market to either continue or what should support the market in one direction. So when price is pushing to the upside, I'm not looking at higher lows or lower highs or anything like that. I'm looking at how the market's going to react trading into down close candles. So if I'm bullish, I'm looking for the market to trade into down close candles to support it to the upside. So every time the market trades into a down close candle right here, I'm looking for it to respect it and then push it to the upside. And that's what we do. And this shows to me that this market is bullish. So in a bullish market, down close candles are going to support the market to the upside. And let's go over a bearish market. So this is where the market is pushing to the downside. I'm looking at up close candles to support the market lower, and you can see every time we trade into them, we drop to the downside. And this is where I understand that the market is in a bearish order flow. So trusting selling setups on the higher time frame is very likely, and dropping down to the lower time frame, this is where a lot of people don't understand. So I'm just going to go into a bit of critical thinking that you guys might need to apply in your trading. So if you're bullish on the day, for example, the market wants to go higher on the higher time frame basis, you have built a bias per se. The lower time frame, what you're looking at is basically this. You are waiting for the market to manipulate lower. So this is the open low of the daily candle, and this is where you want to be buying. You don't care about any of the other areas within the market. You want to be buying when the market opens up and trades lower. And why do you want to be doing that? This is because you know that's the manipulation phase of the market, and then we'll create the high, and then we will close off. So that's basically what I'm looking for with my logic on the higher time frame. If I'm bullish, this is what my lower time frame fractal should look like. And the same things applied if I am bearish. We're looking for the open high, low, and then waiting for the market to close off. And this is where I typically, or I want to be selling within the market. Either it's the New York or the London session. These levels are where I want to sell and look for the market to trade lower. So we've just been over that. We are going to get into understanding grading price swings, but I wanted to teach you guys about understanding candlestick order flow because this helps a lot with grading price swings. If we look right here, you guys can see we have a high and we have a low. So this is again a dealing range. Ranges are very important, can't put enough emphasis on them. But this fractal that I'm about to teach you and this thing about grading price swings I'm about to teach, you can apply this to lower time frames. It doesn't always have to be the higher time frames. If you're looking to trade, you can use this logic as well. So the 0.25 level, this is important in telling you if the market's going to start changing delivery. So if price starts to close above these levels, so you can see we're starting to close above, this shows to me that we shouldn't trade below this pink line that I've drawn or this orange line that I've drawn. We shouldn't trade past this, and then we are looking at 50%. 50% becomes very important because if the market closes above 50%, then we don't anticipate the market to come back any lower. So around these levels is where we can look for our buying opportunity. This is because this is where an area of fair value is being created, but also we have graded our price swings to show us that the market wants to trade higher now. So this is where it's optimal for you to buy if you didn't get in on the 0.25, and then we have the 0.75. This is very important because once the market closes above this level, this shows to us that we shouldn't return anywhere near 0.5 or the 0.25. If we do return back to the 0.5 level, so the 50%, nobody should close below this. So you can see this is where the market will trade the fastest and the quickest to its drawn liquidity. And that's exactly how grading price swings work. You grade where the market is. So we had a range high and we had a range low. This is where we graded our price swing. We waited for a confirmation above 0.25. We waited for 50%, and then you can look to buy around these levels. This basically confirms that price wants to trade higher. And you can see this down close candle that was made in this price leg. This is where we trade back into and then push to the upside. So this is where I'm using grading price swings to tell me where the higher time frame wants to go, because on the lower time frame, I'm basically looking for runs that trade to the downside because I know this is the manipulation move that the market's within, and I can look to trade this and buy this to the upside. And that's basically the framework to my trading. But don't worry, we're about to get into a flowchart regarding building a mechanical system, and then we're going to hop into the charts. Okay, so now we're going to go over the approach of building a mechanical system and what you should be focusing on. So this is basically a small little flowchart of what I like to look for. So you're always using the higher time frame bias and building a narrative based off the higher time frame. Whatever the higher time frame is, bullish or bearish, this is what's going to replicate into the lower time frames and how you're going to be able to frame your trades. So first things first, the foundation to everything. The foundation to everything is a dealing range. Obviously the higher time frames also the foundation, but once you know the range of the market, you are looking for liquidity hunts. You're looking for liquidity hunts at a very specific time. And once you do get that liquidity hunt, what is the next thing you wait for? The next thing you wait for is a change in the state of delivery. So this just confirms that the market wants to trade higher, but you don't always need to use a change in delivery. What we just went over, if you made it that far into the video, that was about grading a price swing. You can use a graded price swing. So if price closes above 0.25, this is also going to support the idea that price wants to trade in the direction you want it to. So if we have no change in the state of delivery, what do? You wait for the market to change its delivery. If it doesn't change delivery, guess what? You don't have a trade. You step back and you just repeat this process all over again. If you do have a trade, however, you're looking at order blocks for your entry, as we spoke about. Down close candles are going to support the market higher. Up close candles are going to support the market lower. So you're going to use order blocks for your entry. You're going to enter and you're going to aim for whatever risk to reward you like to have. You could either aim for a 1 to 2 trading setup, or if you wanted to have better risk to reward, you can go over my video where I spoke about rejection blocks. That's where you'll find the best entries within the market, and we will break that trade down once we get into the charts. So this is basically creating a whole mechanical system and a step-by-step approach that I like to have within these markets. And now we are going to move on to the charts, and I'm going to break it down step by step even more of how I like to to trade and the system that I have built out. So I'm basically giving you everything for free. And if you do want to learn more about it, I do have a free course. So if you go into the comments down below, that will be the pinned message and you can just claim that free course, and it's obviously free. You can learn more about my approach to these markets, but right now I'm giving you everything in a small summarized video. So with that being said, let's move on to the charts. I've taken off my glasses, so that means we can look at the chart and go over everything step by step of how to build a mechanical system. And the first thing to a mechanical system, as we went over, was the psychological part of trading, why most traders fail and why most traders can't get to a point of consistency within the market. And once you actually understand which bracket you fall under, that's where you can sit down with yourself and speak about how you can really better yourself as a trader. And now looking at these markets, this is where we can start building on the external factors, which is the technical analysis, because I do believe technical analysis does play a key part in trading. So there's like two ways you can go about trading. The first way is you can go for years on end, just failing and failing and failing over and over again. And then one day you might have a lucky day where you can recover all those losses. But to me, that is just pure gambling. Or you can learn the markets the right way and sit down with yourself and be able to identify what's going on, how you want to trade it, and think of the markets very logically and take calculated trades with proper risk management. And that to me is real trading and understanding what you are doing. And with a mechanical system that we're about to get into, building the higher time frame narrative is very important. So the first thing we spoke about was the grading price swings part. So to me, when I look at this price range, before this low even got ran, this was the lowest low of this dealing range, and this was the highest high of this dealing range. So this is where a range is created within the market. And you might be asking, okay, that's a range, but what if you zoom out? There's probably more ranges. And you are correct. There is loads of ranges. Look into these markets, all of these ranges. And you might be asking, okay, why did you pick that high in particular? So why am I picking this high? And why am I picking this low? Why am I not picking this low? Why am I not picking this low or this high? So let's get into all of that, because that's about to clear a few questions up. So when you're trading, what are you trading? You're trading the current price action. Why do you care about so far back in time unless you are swing trading? If you're swing trading, then yes, I would agree you need to look further back in time. But when you are day trading or you are scalping, you need to look at the present. You need to look at what's just happened within the market. And what has just happened? So we made this high. Once we made this high, what happened to the market? This high stayed intact and it became the highest high that was made before all of this price action right there. And then we traded back into the range. So as we traded back into the range, what does this high become? This becomes the high of our dealing range. And then we had liquidity resting below this low, liquidity resting below this low, and liquidity resting below that low. So what is this? These are triple equal lows right now. So to me, what I like to look for is liquidity resting below there. So here we can look for the market to trade into there. And why are we not looking for the market to trade even lower into there? The market can trade lower and it can go into there. But if you look at this logically, you can see you could draw out this high to the low. Where do we trade into? We just trade into below 50%, find a discount, react off 0.25 and push away. So why does that low become irrelevant to me? Why don't I expect the market to get into this low? It's because we took out a sell side below this and then we started to reject away. So me, when I'm looking at this price action, this becomes important. Let me draw this out in time. This is a range that becomes important, and that high that up there, that becomes important to me as well, because I want to see the market take that out. So once we create a range, so these lows that we took out, sell side, and then we have buy side. Let me draw that again. And we have buy side above that. So now this is what I'm looking to do. I'm looking to grade my price swing. So we have a high and we have a low. So let me remove this back to this right there. So we have our graded price swing. So from this dealing range low to the high, where we run out the sell side liquidity and where we want to target the buy side liquidity. So when we look at this fractal, you can see we have the 0.25 level. This is where the confirmation is going to start. So how do you know the market wants to start trading higher? This is where I'm looking at the 0.25 level. Once we close this with a body, I'm like, okay, this market can really trade higher. And then we have the 0.5 level. So this is 50%, this is basically where we want to see the market close above and not return back to 0.25. So once we close above with this candle, you can see we have no return back to 0.25. We do have a rejection away from 50%. You see this is where the market trades back into that level. And now this is the price action that pushed the market to the upside. But how about the price action that failed? So this is the market cycle that failed. So this is where we closed above 0.25 and 50%. Look at 0.75, taps it, rejects away, and comes back. So this is where, if the market's going to expand, it needs to close above 0.75. So I know that's a lot of numbers I'm throwing around right there, but if you watch this video back and just look at what I'm speaking about, you'll be able to identify what's going on and how you can really utilize this in your trading. So 0.25, confirmation the market wants to go higher. Closure above 0.5, market should continue. Trades into 0.75. This is where if we close above, the market is really going to rally and it's going to give no pullback. And what did we speak about? We spoke about breakaway gaps before, right? Breakaway gaps forming right here. This is a delayed delivery. So as we're pushing to the upside, if the Nasdaq wanted later on in time, it can reverse. And where is the logical areas it can go into? It can come into these breakaway gaps. So these are staying open because the market created a balanced price range just below it. So you can see where if we go on to the lower time frame, this is where we were creating a buy side, sell side, buy side. So this range becomes balanced. Once we balance out this range, what does the market have to do? It has to create a speed run, and this is where we push to the upside. Again, same thing happens. Balanced price range is created, breakaway gaps, pushing to the upside until we trade into a higher time frame draw. But that's amazing and all, okay? So we've identified where the market would want to go higher. We built out a bias using the higher time frame. But how do you mechanically trade this? Well, this is very simple. I'm also going to break down one of my trades that I did take with this logic. So if we go back all the way to here, I'm just going to remove some of this. I'm zooming into this price action right here. The most important time for me is 9:30. So you can see this is 9:30 right there. And this is the long that I did take. So I'm going to post a screenshot of that. You guys can see where I caught the bottom of this market, but I also want to break down exactly how I did it. So off the higher time frame, mechanically, what are we looking for? We're looking for buys. Why are we looking for buys? Because we are bullish. So we have a buy side liquidity pool above this. We have a sell side liquidity pool below this. And you're probably asking, Ralph, again, why are we using this high and low? Why are we not zooming out and using all of these highs and lows? Well, this is very simple, and we're about to go over this again. So here, we had a liquidity pool. You see how equal these highs are. Instead of just picking one, you just pick the one that's the highest of these relative equal highs. Draw it out in time, we trade into it, take out the buy side. So that high to me is irrelevant. However, this low still holds a bit of importance to me. Not the most, because it is a low that was made right at market open and then we rallied higher. So this is the range that the market trades within. Same thing, right? We have a low, we have a high. When the market creates such large wicks, I like to ignore the wicks because they are manipulation wicks. I'm only focusing on the bodies. So if we focus on the bodies alone, we can see where does the market trade back into? The market trades back into 50%. So what does it find? It finds a discount. So you're using ranges to find areas that the market can come back into. And it's very logical trading. This is very logical. If the market does this, then you're going to do that. It's very mechanical as well. So once we trade into 50%, you know, and we reject away, this is a discount that the market's found. And this is your most recent range. So we have a low and we have a high. So why is this the most recent high and why is this the most recent low? We make this high, pushes the market to the downside. We make this low, pushes the market to the inside. So now we have a high right there. We have a low right there. All we are doing is waiting for the market to take out one side of this range. And for us, we understand this is a low and this is a high. And this is the midpoint that was made within the market. There's always going to be an equilibrium within this. We trade into the equilibrium. Once we do that, we are looking for change in deliveries to show us this market wants to go higher. So this is where I moved on to the lower time frame. So this is where the M1 price action formed. So again, we are looking at the most important element, which is time. So right on time, we hunt the sell side liquidity. And then what do we have above these highs? We have buy side liquidity and liquidity resting above there. So that's two elements of a mechanical system ticked off. We found our range. We found liquidity that's been taken within the market. And then the next thing is understanding where to enter within the market. So for me, I was looking at this 5-minute rejection block. So as soon as we traded into, let me bring this price action back. We spoke about before, we traded into 50% of this overall range. So we found a discount. And then I'm looking at this wick and this rejection block. As we trade into this wick and start to respect 50%, this is where I'm thinking, okay, this market can go higher. So straight from here, we react off 50%, and this is where I bought long. So again, I'm not saying this trade didn't have a bit of luck to it. It did, but this was very logical and why I was looking for my buying setup. So this is where I bought long. I think it was around a 13-point stop, or it might have been a bit more. Something like this is where I bought long within the market, and I was targeting the buy side liquidity. So again, if this market did stop me out and I did take a losing trade right there, I would have just simply waited for this. So this is the confirmation entry. We have a gap right here and we have a gap right there. So this is where the market should trade into this gap and trade to the downside if it's really bearish. However, this is what we do. We close above it. So once we close above this, to me shows me that this is a market that wants to trade to the upside, and this is where I'm going to buy long, targeting the buy side liquidity. So this is for around a 1 to 3 trading setup. Same logic, but you're just waiting for a confirmation. But I like to use rejection blocks and wicks for my entries when I have the correct drawn liquidity. So you guys can see this is where we blended the understanding of the higher time frame. So let me go back to the 4-hour time frame right here. This is where we were like, okay, if this market's bullish, this is where we need to close above. This is what we need to do. So we have our range high and low. Once we get above 50%, easy longs to the upside, closure above. So you can really, if you did catch a long from there, you can start looking at the higher time frame to confirm if it wants to trade in the direction you want the market to. So over here, you can see as we're trading higher, you want to see the market get into 0.75. So this is just flipped around. But same thing, once it closes above, you know, you can really hold this, because once it trades into 0.75, we really shouldn't come back to 50%. It should just rally on from there. And using this logic, you can really start to catch some monstrous moves. So I hope this video was insightful. It was slightly a long video, but I wanted to give you as much information as possible regarding a mechanical system, but also how I like to trade and view these markets, because the higher time frame is very important. Once you know where the higher time frame wants to go, trading on the lower time frame is very simple, because you just using an approach of ranges where 50% is looking for retracement. So it's premium and discount, looking for change in deliveries for the market to confirm it wants to go in that direction. And if you do get a good entry, then obviously you can hold that position for a longer period of time if you wanted to. And this same approach, you can apply it to a higher time frame basis as well. With that being said, I hope you did find this video insightful. And if you do have any questions, make sure to leave them in the comments down below. And if you have made it this far into the video and you do want to learn more from me in depth, more about these markets, how the markets move, and most importantly, the why aspect. Like, why did price trade down to here? Why did price move up to there? That's basically what I teach within my one-on-one mentorship. So that program is not designed for traders who just want to get rich quick. It's actually designed for traders who want to understand the markets a lot better, understand why these markets are moving the way they are, and why certain things are happening within the market, because obviously nothing is random to these markets. Or you think you got what it takes, then go into the link in the description. It will be the top one. You can apply for the program. And if you think it's a right fit in the interview process and we think we can move forward, then we will. And I'll take you on board under my wing and I'll teach you what I know regarding these markets in a lot more detail. But with that being said, I hope you did find this video insightful. Again, if you have any questions, let me know inside of the comment section. As always, remember, I'm rooting for you and I hope you do find success in this business. Enjoy the rest of your day.